This is a fairly important topic we're going to be talking about today because it's internal controls. And you'll be discussing this when you take your internal auditing class. You'll be discussing it again when you take your external auditing class. This semester, it keeps coming up in every time and every discussion that we have when we start talking about our cycles, because that's one aspect that we need to cover when we have a properly functioning AIS system. We need to have good, strong internal controls within all the cycles. So in our minds, when we start designing or when we start changing or we start thinking about developing an AIS, we have to have internal controls in mind. Because without internal controls, you don't have a functioning AIS. You need them. So we have to talk about what internal controls are, and we also have to talk about what good internal controls are. You are going to use your Gleim book for this, as well as the PowerPoints, and the Gleim book will be a special unit that's going to be called COSO frameworks. So the COSO framework, COSO is an organization whose intent or whose purpose was to provide for good internal controls. You have a number of items. It's outline form for Gleim in that book, and I would say I'm going to spend less emphasis on enterprise risk management. We call that ERM. Than on the other parts of that chapter. After you go through the outline in that chapter, you're going to find some problems, and the problems all have solutions. So it might be helpful if you would read through the problems, and my anticipation is not that you would have the ability to work through those problems perfectly, because they are CPA exam problems. You're not going to be taking the CPA exam until you get to 150 credit hours, or in the semester where you're at 150 credit hours. It's far off for most of you, so I don't anticipate that you should be able to answer all of those questions perfectly. Likewise, when you get into your quizzes and work through the quiz, which is associated with this module, and it is going to be in Gleim, I'm fairly lenient with the number of attempts you get to complete the quiz. So you should go back and you can look back at your outline and look at the topics, and there's plenty of time to work through that quiz. But it does have a due date. It's just that once you start it, I give you plenty of time to complete it. In this module also, you have a case, and the case is going to be on internal controls, and you will have to make a submission. The due date for some things in this module is later than for other things. So we have a quiz in Canvas to complete that's associated with this PowerPoint. We have a quiz in Gleim, which is associated with the Gleim book. And in this PowerPoint, I'll talk about COSO, but the Gleim book gives you the detail you need for the quiz. And then the third thing you have is the Never Sink Canoe case, and you need to work on that. That will take a lot of time, I think. Then after you've done that, you complete this module, then we need to do preparation for exam 1. And so preparation for exam 1 is going to be showing up as a page within this module, but it's not new material. It's just telling you what you need to do to prepare for your exam. And the exam will be given according to the schedule, which you should be able to access. Every time I add a module, I'm going to try to update you and give you a new schedule. So if you click on the links for schedule, you should always see the updated schedule. At least that's what I'm trying to do. If you see that's not the case, let me know that I need to fix my link. So internal controls, all important, internal controls. What is internal control? What are internal controls, and why do we need internal controls? And then we have the types of controls that exist. And we're going to start talking more about the COSO framework in 3 and in 4, because in 3 we're going to talk about tone at the top and why tone at the top is so important. The COSO framework, the book in Gleim, talks about it in greater detail, and it talks about who's responsible for what within an organization. I think that's really good discussion there as you're reading through the Gleim materials. Then how do you achieve it, or when do you think you have achieved a good tone at the top, and what does that look like? And then lastly, of course, is the COSO framework, and that you get mainly from going through the outline and reading about what COSO is and what the framework is in Gleim. I like to say internal control is PETER, and this is an acronym. It is the policies that exist. It is efficiency. It is a discussion of theft and errors, and it's talking about reliability. So, policies. It's the policies that encourage adherence or following through or compiling or obeying, if you want to say that, the policies and procedures that exist for the enterprise. This includes also laws, okay? So Foreign Corrupt Practices Act, OSHA, any law that the organization should be abiding by, may be specific to the industry. It may be just something that all companies have to abide by, such as Fair Labor Standard laws. It may be the way that they are required to interface with the IRS and report withholding. It may be dealing with the SEC. So those broad laws or even detailed laws go under this first policies area. It is also the policies and procedures that are in place for the company that are associated with the AIS system. So even though it says policies and procedures, it's laws also, and it is also talking about all policies and procedures, and not just AIS, but we talk a lot about the AIS policies and procedures, because without policies and procedures, your AIS is going to fall apart. You know, we talked about documents and the importance of documents. So if you have a company and the proper procedure is this step happens and this step happens and then this step happens, and if you follow those steps and you create the documents and then you create the authorization for the transactions to be happening and you do all of these steps, then your AIS can function. If you don't follow the steps, or another word for that is procedures, then your AIS doesn't function. You don't get the documents created, or there's not the reliability of the documents. Then you can see how everything collapses. So internal control, the P part, is having these policies in place, and it's also an enforcement. It's an enforcement. It's saying you must follow these. Because if you don't create the document, you know what I say, it didn't happen. So you have to have compliance with the policies. And you have to have a way of enforcing it, a way of making people do it. So the policing aspect of accounting was something that was very strange to me when I first started working, because I thought, you know, accountants are people that do debits and credits, right? Somebody tells me that this has happened, and then I do a debit and credit, and that's what I thought my job was. But when I got out there and I started working, I started seeing that there's a system. There's a system that the company has established, and it's a way of doing things. And then I saw that if we let people go around the system, then the system would just collapse. It would. So, as an AIS professional, you see yourself becoming a cop, and it's like you're the bad person, and it becomes a little bit adversarial because people that aren't in accounting and don't work with the AIS, they don't really see the whole picture. They don't see how that if someone doesn't do the thing they were supposed to do, if they don't do this step, then the other steps don't happen. They don't see it as a kind of a chain reaction or a process, right? And they just think, well, I don't have time to do this. This is a lot of paperwork. I don't want to do this, right? I'd rather be out there making sales than preparing these documents. And it just falls apart. Oh, wait, no. A good example I have of this when I was in retail is the store managers would move merchandise between the stores. Okay, so one store has too many of this size and the other store has too many of that size, and it's the same identical item in merchandise, so they're going to move it from that store to that store, and they're going to transfer it. We call those transfers. Well, why is it important? Well, they do the inventory at the end of the year, and the stores will be short on something and they'll be over on something else. Why also is it important? When a customer calls and you want to know that this item is in inventory, if they don't take it out of inventory when it goes to the other store, it's going to look like they've got it when they don't have it. But to a store manager, they might not see all of this. To a store manager, they might just say, well, I'm busy making sales, or I'm busy staffing for the week, and sure, I'll send that over to your store and not do the paperwork, right? But without the paperwork, you don't have the transfer showing up and your inventories are wrong. That is just one of many examples I could give to you of that. So the policies are important, and it puts us in a different sort of a position. Efficiency, promoting operational efficiency, this leads to profitability. So we try to do things that show or assist management reporting and seeing how things can be more efficient. And then when we have good internal controls, we can't get rid of theft and we can't get rid of errors, but we try to minimize those. We try to minimize those. And you might want to put fraud in there if to really expand it. But when we talk about this fraud, we're really talking about a theft type fraud. So theft should cover fraud. And we aren't able to get rid of or eliminate theft or eliminate errors. And you know that we're all human, we make errors. And you can't really get rid of all theft because there's so much costs involved in creating such barriers to theft that it reduces number 2, which is efficiency. And it often reduces profitability because it affects your revenues. So theft and errors you can only minimize, you can never eliminate. And then the reliability of accounting records. What we want to say here is it's never going to be completely accurate. We just want to enhance. You see the word enhance? You want to enhance it. You just want to make it so that your accounting records can be relied upon by the individuals who are using the AIS system. That might be the external people, such as the vendors or the people, your customers who are buying from you. It might be the people who are working within the organization and looking and using the accounting data. It might be in financial reporting. The point being that the users can rely upon the data, and it becomes information if they're going to act upon it. So the information is good information. They can use it to make decisions. That's what we're talking about. Again, Peter, policies that are in place that promote efficiency, minimize theft and errors, and you have reliability in your accounting records. This is what we want to see when we see internal controls. Some of the objectives which COSO has are a little bit different from what we show here, but if you look down at the bottom, you see that there's a lot of overlap here. Internal control objectives, and I'm going to say activities on another slide, so just so you see the distinction here, this is objectives. What do we want when we have Peter in place? What is it going to accomplish for us? And we're going to say that our assets are safeguarded. Like reliability, we have accuracy and integrity in that accounting data. The efficiency, we have operating efficiency, and we can comply with whatever management wants us to do. And when you get into the Gleim book and you start reading about the COSO framework, they are going to start talking about objectives. And when they're talking about objectives, they're talking about goals. They're talking about things that the company wants to accomplish. Okay, and that ties directly into the management directives line here. Safeguarding of assets. Well, safeguarding of assets means you should have some protection from fraud, theft, and by the way, misuse of an asset is also considered theft because you are using up the asset, and you are using up the asset not for the company's goals to be attained, but for your own personal needs or desires. That misuse is a form of theft. And then your accounting records that go along with the safeguarding of assets, you have accounting records that are reasonably free of errors. So here's an example for you. You have an asset. The asset is inventory. The accounting records that go along with the inventory should match up to the actual inventory. If your inventory item says, inventory listing says you have 10 of XYZ, you should be able to go out there and you should find 10 XYZ. Okay? So the accounting records themselves, you would think of them, should be starting to think of them as assets. We talked about it a little bit before. You have to protect them. You have to protect them. You have to be able to continue with them. They have some continuity to them. They don't just disappear. So if you need to access those records, you can, and you have backups and a way to keep the assets, these assets that are the accounting records, safe. And there's no hacking into them. There's security associated with your accounting records. Remember, accounting records often have information about your customers. So you need to protect them. You need to safeguard accounting records. You need to safeguard assets of any kind. There's some examples I have down here, and this is related to an asset called an automobile. And I will tell you a story, and I'll return to that story. We have a service organization, and this service organization, they have vehicles and they use them to go out and service. And let's make it a plumbing company. So they fix your problem. You need a plumber, you call them, they will come to you, they'll get in their vehicle and they'll come to your location. This plumbing company has a back door, and the back door is kept unlocked, and by the back door they have keys, and they have a key for each one of their vehicles, and the key fob for each one of the vehicles, so the little chain device, has the automobile tag number on it. So if you wanted a particular automobile to take out on your job, you would just look there for that particular automobile tag license plate and compare it to that the fob that's on the key, and that would be the key that you would need for that vehicle. Okay. And so all you do is if you have an emergency call and, you know, in the middle of the night someone's pipe broke and you need to go and help them, you just go there, open up the back door, grab the appropriate key, and then you go to the client or individual's house. What's the problem here? There's a number of problems. The automobiles themselves are not stored in a secure place. They're just out there. Anyone can take them. Okay? Now that in itself is not a big problem. However, the key to the automobile can be accessed by anyone in this case. And what does it say here? It says selected employees. So a part of your policies and procedures of your organization should be who drives the car, who drives what car. That's another important thing. If they have all these fleet of vehicles, how do they know who drove the car in an unauthorized way? Here's an example. An employee has a family gathering and they don't have a vehicle that's big enough to hold all the members of their family. So they go to work and they take the company van and everyone gets in the company van and they go to the family reunion. Is there a problem here? Yes, that would qualify as misuse, as I described previously, because they're using up the asset and they're not using the asset for company business. They're using it for their own business. So if you have an automobile and that automobile is in effect assigned to this individual or maybe two individuals, and there's misuse of the automobile, then you can say it's probably misuse by this individual or that individual. But if there's misuse, no one's in the office, it's the weekend, and you have a policy where any of these vehicles can be used by anyone, then you come up with a problem because you don't know who misused it. So assign the vehicle to the employee. And it may be a couple employees to a vehicle, or it may be a couple vehicles to one employee, but you need to have that assignment done. So automobiles are in a secure facility. The key to the automobile can only be accessed by select employees. Hanging the key by the back door is not a good idea. Leaving the door unlocked is a bad idea. Company records. I said the records are like assets themselves. They're going to have a complete description. They're going to have the serial numbers of the automobiles. And when we get into this and we talk about the fixed asset subsidiary ledger, you're going to see that they're also going to include records as to when its oil should be changed, when it got the tires, when the tires need to be replaced, any major work done on the vehicle, the warranty. There's going to be a lot of information that's kept associated with the automobiles. And somewhere we're going to talk about access and usage and relate that to employees. When you sell the asset, it triggers an update to fixed asset control files, and you follow the procedures and policies associated with the sale of assets. This is important because fraud can happen there. I just want you to understand, fraud can happen with sale of assets. An example, an employee has a son who needs a vehicle. They're going to be going off to college, they can get a vehicle. So the employee goes and says, this vehicle is not running well. I want to just salvage the vehicle and take whatever I can get. So they sell the vehicle to their son for a very low price. And actually the vehicle is a reliable vehicle. What has happened? You have an example of fraud. You have an example of fraud happening. So you need a procedure to determine when that vehicle should be retired. What's the criteria for that? How do you determine when it is? And then you need a criteria, you need some sort of a policy procedure in place for how you dispose of it. Maybe you're going to say it has to be the blue book value. Maybe you're going to say it has to be advertised for sale in a newspaper. There are a number of different ways to handle it, but you have to think about it and you have to set up those policies. Approval is required for all sale of automobiles. Another good idea, right? So anyone who approved it could see that this individual was selling the vehicle to his son or his brother-in-law, right? The control environment. This is where we talk about 3 different controls. The first 2 are fairly easy. The third one is a little confusing. This is often referred to as a preventive detective control model, and in the Hall textbook I used to use, that's what they called it. You would need all of these to have a properly functioning AIS. You have preventive controls. Preventive controls are meant to preclude threats to safeguarding of assets or to accuracy of record keeping. It says to prevent or preclude. You cannot always eliminate everything bad from happening. Okay? You minimize the bad things. So we are going to try to minimize the bad things from happening by having some sort of preventive measures in place. And we'll talk a little more about that. So locking things up, yes, that's a preventive measure. What about the computer terminals? If you have to have a password on the terminal, that's a preventive control. When you hire your new employees, you do a background check to see that they haven't been arrested. That's a preventive control. A detection control or a detective control is you're acting like a detective and you're trying to figure out why there has been a breach, why your preventive controls did not work properly. So when you have detective controls, you can look at the situation and say, oh, this is why it didn't work. And so if you have detective controls in place, you can figure out why your preventive controls didn't work. It's very confusing, isn't it? A good example here is a bank reconciliation. When you do the bank reconciliation, you can see that some deposits didn't make it to the bank. Then you can look at that and say, well, we had preventive controls, including telling our employees to always make the deposits at the end of each day, but then you realize something didn't work quite right there. And you find it because you have the detection or detective controls that's in the bank reconciliation. You bill a customer for the wrong amount. How do you know you billed the customer for the wrong amount? The customer calls in and you have a call center where the customer can call in and say, I've been billed for the wrong amount. That is a detective or detection control, having that place independent of your accounting functioning where the customer can call in. Then you have corrective controls. And a corrective control, as I said, is a little confusing because what a corrective control is really a kind of a feedback loop. It says, let's go back up there to the top in our preventive controls and let's change them. So corrective controls are just controls that you do or the changes you make in your preventive controls to make them work. These corrective controls can only happen after you have detected there's a problem. So if you don't have a way to detect there's a problem, then you won't be able to correct the problem. So that's important. So corrective controls are the new steps that you do to safeguard the company. So corrective controls are the new things you do up there at the top with the preventive controls. Now sometimes you're going to find that you need to also change your detective controls. So the bank reconciliation, we don't do it but every 5 months. Well, that's too long, right? You need to do it monthly. So you go back and you change your detection or detective controls. Anything that changes things is corrective controls. Preventive controls. Access to automobiles by only selected employees is a preventive control. Background checks on employees, that is. Passwords, I mentioned that. Something you might not have thought about as a preventive control is insurance on property. What does insurance on property do? It says that if we have a loss, we won't really have a loss because insurance is going to pay. Of course, you have your deductibles and some other issues there, but that's the premise of insurance of property. Detective controls are the bank reconciliations, but actually any type of a reconciliation which is done. Anytime you have an asset that has a physical presence, whether it's fixed assets or whether it's inventory, you should be going out and comparing, and we're going to call this reconciling, the amount which you actually see and the amount which is in your accounting records. I did this for buses, for all the buses in the city of Dallas, Texas. So when I was an auditor and I worked in public accounting, that was one of the many jobs I did, and many assignments. And so I went out there and we took the serial numbers off of the bus. So any of you watch the movie Speed? It's kind of an old movie, and it's about a bus, and it's a bus that was hijacked. So on the bus you actually had many different fixed asset items that we had to inventory. We had to inventory the coin counter, which is where individual comes on the bus, and they used to use coins then, and they'd put the coins in the box. We had to inventory the bus itself. We had to inventory a communication system. We had to inventory also this device that would somehow tell the headquarters where the bus was at all times. We have these now, and they're tied into GPS systems, fairly common. They're on long haul trailers, the trucks, semis. They're on trains. But back then it was kind of novel, so we had those so that we'd know if the bus was stopped at a location too long, and if the bus had maybe been stolen or what had happened, we would know this is the schedule and this is where the bus is. So we had all these PP&E items that we had to inventory, and we had to make sure that they matched up to the records. At the end of it, we found we'd lost 4 buses. 4 buses were missing. So we had to find out where the buses had gone, and at long last we found out that they were at repair shops. So that was our reconciliation. We took the physical count, we checked those boxes off, and we had our records, and they didn't match up. We had 4 missing. The reconciliation told us where the buses were. So anything that you can physically handle or see, we call that tangible. Anything tangible, you can do a reconciliation of. And another one here is a bank reconciliation. With the bank reconciliation, you have the bank saying this is what your account has. Mandatory vacations. What about these mandatory vacations? How are these detective controls? My example of this is I used to work for UTHSCD. Any of you from Dallas? That's a healthcare system, and the healthcare system for the University of Texas. And one thing that I did was I worked in accounting, and I processed the travel vouchers for the doctors who traveled to different locations. And I was assigned doctors whose last names were certain letters of the alphabet. Another lady, her name was Alice. She had another group. And then we had another lady named Pam, and Pam had another group. Okay, well, Pam goes on vacation, which she should do. You should have mandatory vacations. All employees should go on vacation. And when she went on vacation, we decided, we will just split up the work between us. So Alice and I would handle Pam's work. We discovered when Pam left that there was no work to do. We didn't have any more work to do. So what did we learn from that? We learned that we didn't have efficient operations because Pam was not doing enough work. So yeah, we were kind of angry with Pam when she came back. But mandatory vacations are also good because if Pam was doing her job bad, we would see it because we're going to jump in where she left off and we would say, wait a minute, this is wrong. This calculation is wrong. She didn't do this step. She should have done this step. She didn't follow the procedures. You're going to see it. That's a detective control. You're going to see something that's not right. All right. If a person is committing fraud and they're moving money from one account to the other to cover up an embezzlement, if they get interrupted by a vacation, then the person who steps into that position can see things aren't right here. This is just not right. So you can find fraud that way as well. But the mandatory vacations are also good, not only as detective controls, but because you have cross-trained your employees. So if something happened to Pam, and Pam didn't come back from vacation, maybe she got a different job, we could still carry on because we would know how to do Pam's job. So mandatory vacations are so important. And here we list them as detective controls. And I'm using detective and detection controls interchangeably, and I hope you see that. Supervisory review is important. And this goes along with the second one, which is a review of shipping log by shipping supervisor. I have another story here. My husband, I was assistant controller, and this is a national retailer. My husband and I went to lunch, and I think I was gone a little more than an hour. I should have just had an hour lunch, I know, but I had a little more than an hour. It wasn't like 2 hours or anything like that. It was just maybe 5 minutes over. So I came back, and my boss, the controller, was standing at the front as you come in the door, and she was a chain smoker, and she was just huffing away on her cigarettes. And I'm like, this is not right. Her name was Judy, and I'm like, Judy's upset. Something's wrong with Judy here. And I thought, I'm late. She's after me. I'm in trouble. But no, what had happened was the one of the employees that I had hired was colluding, and her job, by the way, was working with inventory records. She was colluding. That means she's working with others, and she was working with 2 individuals who worked in the warehouse. And while the shipping supervisor was at lunch, they were packing up merchandise and shipping merchandise out to a post office box that they had rented. Okay, so what happened was a shipping supervisor came back, and he came back from his lunch, and there was a listing, which is a shipping log where he kept track of all the shipments going out, and he saw that the shipment was going to a post office box. We didn't have a customer there. We don't know who we are shipping to. That is not a store. We weren't sending it to our stores. We weren't doing a mass ship to some place, because if he had that, he would have been informed of it. He's the supervisor. He wasn't informed. He starts asking questions, and he finds out that these two people in the warehouse, were shipping it out. Then also what he finds is that there has been an adjustment made to the inventory records that makes it look like it's sent to a store, but it's not sent to a store because it says it's a post office box. It wouldn't be sent to a post office box, it was sent to a store. So yes, they took all three people away. Now the one that I'd hired, this is also interesting and fits properly in here. She was young. She was 20 years old. I talked to her supervisor where she worked, and I also, we did our background check. We had a separate background check which was being done, and the background check was done and came back clean. Well, she was too young. She hadn't had time to establish any records that showed up in a background check. Because if you do juvie things, it doesn't show up on background checks. So it didn't show up. Even if she had them, it wouldn't show up. So we had no way of knowing. Nothing told us there was a problem. We did the preventive control measures before she was hired. And the other thing here is we say, and we will say, we should have ARC. Authorization, record keeping, custody, and we're going to call it separation or segregation of duties. What's the problem? If you have collusion, if you have people that are working together, then they act as if they are one person doing three functions that should never be combined. So talk about that a little more, but it was collusion, and collusion was what got us. So detective controls, it found it, we found it with the review here, and yeah, all three were taken away. And it's really bad when a 20-year-old gets arrested, because that's the start, so young, and it's the start of their career, right? And it's arrest. It's bad. COSO says, as we get into this, that there are 5 physical control activities. Now, when you go and you look at your COSO framework, it's going to look a little bit different than this, and that's fine. They are just organizing it a little bit different. So what I want you to know for purpose of this class is this sort of an organization. The first one is authorizations. So when you have transactions, they're authorized. So if you have a sale and it's a credit sale, should there be some process where you don't give credit sales to just anyone? And that's, yeah, I think that's a good idea, right? So someone authorizes it, or there's a procedure, or there's something that's done for that sale to occur. When you go through and you look at each one of the cycles, we will have these 5 items, and we will discuss the 5 items here as it relates to particular processes that are happening within the cycles. So authorization is number 1. You can have these in any order. It's just that order I have up here. The second one is segregation or separation. I don't care which word you use. On the CPA exam, I've seen it both ways. It's the same thing. It says authorization, record keeping, custody. And I give you examples of what these are. Authorization is what we were talking about above. When we have a transaction, there's an authorization process. Record keeping is journal entries, but it's also doing anything that would generate a journal entry. And this includes the keeping of, say, inventory records. Okay? Then 3 is custody. Custody means holding on to. In the example I just gave you, we had someone who was doing record keeping. that unfortunately the inventory clerk I hired, right? We had 2 people who were in the process of custody, okay? They were doing the custody job because they worked in the warehouse where there's storage or distribution of items. One could argue that when they fraudulently put the item listing in the shipping log, they were authorizing the shipment themselves too, right? You could say that as well. So the 3 were working together, they were colluding, and they were doing ARC. ARC was all being done as a collusion between the individuals, and they were acting as if there was one individual doing ARC. Okay, now let's back up a minute, and let's pretend we don't have collusion. We just have say 3 individuals. Well, if we have 3 individuals, one individual needs to do authorization, one individual needs to do record keeping, and one individual needs to do custody. There's no collusion. There's one individual doing this, there's one individual doing that, and there's an individual doing this. This is assuming we have 3 individuals. Okay? The point we make is that no 2 of these 3 things can be done by one individual. One individual can't do A and C. One individual can't do A and R, and so forth. There's one individual cannot do any 2 things here. Now, let's think about this a minute, because what if you have authorization, record keeping, and custody, but the 3 jobs that the one person are doing are totally unrelated, not in the same cycle, have no relationship to each other at all. We looked at the chart and we said how AIS kind of permeates throughout and that things are related, but there were some things that weren't really related, right? So if you can find something for an individual to do, and they can authorize and they can do the recording, as long as that thing is not related, those 2 things are not related, you can get away with it. But it's really hard to find things that are not related in some way. So all those things should be kept separate, and particularly I want to say a cycle approach to it. So within one cycle, let's not have an individual doing A, R, C. They can do one of those only. I think the cycle approach is usually the best approach. When you're talking about cash, you don't want authorization, you don't want the person doing the journal entries or anything associated with it, and the person handling cash to be the same. We will cover that when we cover cash receipts. Now there's a 4th one that's not in the ARC that's important. The 4th one is the oversight function that you might find in internal audit. So an internal auditor usually isn't the person that's doing the journal entries because they're reviewing it, right? They're not the one that's making authorizations because they're reviewing the authorization. And they're not the one that's having anything to do with custody. So when we think about this, we have a segregation of duties in our basic operational functions and its ARC, but we also have a separation or a segregation that exists in internal audit, or the people that do the oversight. You wouldn't want oversight being a part of the creation, for example, of the documents or the journal entries. You would want oversight to be separate. So the reconciliations or the reviews and that is separate from those 3. An individual could authorize a purchase of merchandise, ship the merchandise, and then not do the journal entry. In the case that I had, someone was actually messing with the inventory records and making it look like the inventory was just moved to a store. So they were doing a journal entry creating a journal entry that was going to remove an inventory item from one location and put it in another location. But instead, what it was really doing was just removing the inventory, the physical nature of it. They were just stealing the inventory, right? So you have to have segregation of duties. We keep returning to that. So authorization, segregation, or separation of duties. The third one is adequate records and documents. And I say records and documents because when you get into records, you're really talking about journal entries as well as the documents. And I don't like to call the journal, remember, a document. But you need the documents to tie together and they become the audit trail. You need an independent person doing these reconciliations. You should have certain things when you have accounting records, including journals, ledgers, doing trial balance, creating financial statements. 4 is very important. When you are the one who is originating the document, and we talked about that, right? Internal documents, the ones that come from your company with your letterhead, or even ones that you're using in between say divisions of your own company. Pre-number them. Establish some numbers in place, okay? So that if there's one that's missing, you know it's missing. Then, as you will learn in your SUA packet, it's a communication network with the documents. So when you create a document, who needs to know? Who needs to approve it? Where does it need to go? The flow of it. When we get in flowcharts, you'll see this. So you can use one form for multiple purposes. For example, someone needs to authorize this transaction. It's on the same document as the evidence that the transaction occurred. You have your authorization. So one document, try to reuse if it makes sense to reuse. The fourth one, security of assets and documents. Here we're talking about limiting access to assets and multiple explanations of this I could give you. We talked about the automobiles. You want to talk about cash. If you have a blank check, that is like cash as long as it's signed, right? Many businesses use stamps now, and there's a stamp signature on it. You don't want to keep the check forms and the stamp in the same place, because someone could come in and they could take out a check and they could take the stamp and they could stamp it and they could put their name on it, or they could put someone's name on it. Probably not their name because it'd be easy to trace, but it becomes cash to them. Independent checks and reconciliations. Remember, this is usually separate from ARC. We want to keep it separate from ARC. And these need to be done. Some of them are done inside, and they are done inside because you have internal audit that has a function and just periodically reviews things or does a review of things that doesn't seem to be where they think there's a problem. They'll have an assignment to go in and look at that division and do work there. But so some of it is already in place as a separate internal audit function. But you also have independent checks and reconciliations being done as a part of your normal procedures day to day. You have individuals who are reviewing the work of others. You're going to see that happening in the SUA. You're going to have individuals who will recalculate, does price times quantity equal the total they have on the invoice? Do these things add up? Some of this can be done within the IT system. When we talk about batch processing, you'll have batch totals. We'll talk about that. Reports that are reviewed for reasonableness. Now, the paid vacations and having your employees take vacations, again, we talked about that. That we said was a detective control, but it's also a way to check on things and make sure it's done properly. Another good independent check is to send a statement out to a customer. If that customer is paid and their statement shows that they still owe, they're going to call in. So another way to check is to have a separate call center for your customers to call in. Oftentimes, there is a separate call center or a separate way for individuals to identify fraud and report fraud to companies, the watchdogs, the call centers that will give you a reward for calling in and saying, I saw this happen, and you can then receive a reward. That is also a way of checking into what is happening and to make sure that your assets are secure, to make sure that there is not something wrong which isn't happening. So that's another method to get at these independent checks. Okay, here's a good one. We have Ed Sims. So at Old City Hall, mail was sorted in a glorified closet, not the sort of place you'd expect to be frequented by a high-ranking city official with multiple degrees. Okay, so when I read that to you, you're going to say, well, there's something wrong with doing the mail in a closet. I can tell by that statement there that there's something wrong. And this is the approach I want you to use when you have your case in this module. You read it, there's something wrong. So I do not think that the city official should be sorting the mail, right? And they say glorified closet implies that it shouldn't be done in a closet. And it says not the sort of place expected to be frequented by. So there's some sort of a cloistering going on. Something's trying to be covered up there. You get that from that statement? But the CFO, or the mayor, is Ed Sims, and he has an interest in the mail. He goes out and he actually greets the mail carrier to get the delivery of the mail. Then he runs into the closet and he removes envelopes and he parcels and he takes them into his own office. And then other times he's going to ask people to pay them by hand. So he doesn't even go into the closet where they process the mail. He just takes it into his office himself. And so, of course, what he's doing is he's going through the mail, he's taking out the cash, or he is taking out the checks, and he's putting them in his bank account. So you have to look at this, and you have to go back to those 5 components. Maybe I should go back to the previous slide and where we have them all. So what is happening with him? If he has control over the bank account, he is in an authorization role, is he not? Okay, he can authorize what goes into the account. He can authorize the money that goes out of the account. Yeah. And what do you call handling the checks? If the checks are assets and he's handling them, what a part of ARC is he doing? Custody, right. Now, the other part of ARC, so this is on 2, we've moved on to 2, which is ARC. Record keeping. What about record keeping? Can record keeping happen if the checks never really get to the enterprise? Right, it can't happen. So he circumvented record keeping, and he's done A and C. He has violated segregation of duties. Under 3, adequate records and documents. We need something that tells us that that check came into us. Another thing I would say along the lines of this is we need a post office box or a place where we actually pick up the checks. And when we pick up the checks, we then create that record that says these were the checks that we picked up or we process, right? So we have a violation of 3. Security of assets and documents. Well, yeah, we have a problem, right? Because the cash is not safe. It's gone directly into his hands. And I'm thinking what he's doing is he has his name on the bank account. And maybe he's asking people to make out the check to him, or maybe he is just, because he's handling and having control or custody of that bank account with authorization, he can just take the money out after it's deposited. Independent checks and reconciliations. Now, if it never gets to the bank and it never gets to the accounting system, will a bank reconciliation catch it? No, because it doesn't show up in the bank's accounts and it doesn't show up in our accounts. There's no reconciliation between the two. They're identical, right? Because there's no difference in this particular instance. But what will happen here is the people who have paid their accounts are going to call. They're going to call. I paid my bill, and here you're telling me that my bill, probably a water or utility bill, is outstanding for last month. I know I paid it. So this is the thing here that's going to cause a problem. If he answers the phone and handles the complaints, that's going to be a perpetual problem. So we talked about those components. We talk about how they might be violated. Now let's talk about how we can improve the problem. We can improve the problem by hiring additional employees. We need to have segregation of duties. So we need to have, he can go ahead and authorize things if he wants, but he cannot do the record keeping, and he should not be handling the checks or the money as it comes in. So he could authorize payments going out. Now, if he's going to authorize payments going out, what we still need is probably some sort of an internal audit type function. We need someone overseeing things. So you need reviews. You need that outside checking going on. And what happens with cities now is you have state auditors coming in and reviewing. What the state auditors are finding in many states, most states, I know I've seen it in Missouri, I've seen it in Kansas, those are the two that I have most close ties to. They come in and they look at a city, and what they find out is that the city only has one clerk. One clerk. What is the clerk doing? The clerk is processing all the payments coming in. The clerk can write all the checks. The clerk does all the record keeping. So one individual is doing everything. And this one individual, if you have a situation there's only one individual, it's usually a city that doesn't have much money, and they need to save all the money they can, probably by having their citizens pay low property taxes. They don't have money, so they hire one employee and they're thinking, well, this is good. We've saved a lot of money. No, because what's going to happen is this employee makes below or at minimum wage, probably at minimum wage, I'd say that, and they don't think it's fair. They don't think it's right. But they don't get a raise, and they will never get a raise. And so what do? They commit fraud. They move the money from the bank account to their personal accounts, or they use the money in the bank account to pay their husband or their wife for some minor thing, but overpay. So in effect, it's fraud. So this happens over and over again. Now, I would like for you to look at your systems understanding aid, and I would like for you to turn to page 6 and 7 of basketball. In 6 and 7 of basketball, we start talking about warrant accounting, and I think I've referred you back to this before in this chapter, but now let's look over here on page 7 where we have Ray Kramer, Jim Adams, and Nancy Ford. And let's see if we can see some violations of segregation or separation of duties. Ray Kramer does cash deposits and bank reconciliations. Okay, what is a cash deposit? Custody. What is a bank reconciliation? It's oversight, but it's also going to be resulting in record keeping because you're going to have probably journal entries, right? And then it also says he signs the checks. So he has control over what's going in, he has control of what's going out, and he does the oversight. Is this a problem? Yes, it is a problem. Now, another thing he does is he approves things. So, he approves the time record reports and other approvals. And what you're going to see is he signs checks for his own pay. That's bad, right? Okay, Jim Adams. He keeps the payroll records and he prepares the payroll checks. What do you think? He is an employee, by the way. Right. Nancy Ford prepares purchase orders and she also ships and receives goods. What do you think about this? She has custody of things that are coming in. When she prepares a purchase order, she's doing really the authorization to order something. What could she do? Right. She could order something and she could ship it to herself. She could say it was received in, but she could take it home, right? So she does the shipping and the receiving documents. So that's a problem. So when you look at this, how many employees do they have? 3. We can make it an exercise to try to figure out a way to do this whole packet and have ARC happening. But even if we got ARC happening, we don't have oversight, right? I mean, we could have Ray Kramer do authorizations, we could have Jim Adams do all the record keeping, and we could have Nancy doing all the custody work. But if we don't have oversight, who's going to do oversight then? So the impossibility that we have with this packet is that we only have the 3 employees. Far too much going on, and we only have 3 employees. This is a problem. Let's talk a bit about COSO. My discussion of COSO is brief, and it's brief because you're going to be looking at your Gleim book, and I think it's the second unit. They call these study units. SU is a study unit. So when you go there, you'll actually see a study unit for COSO framework. It's called COSO, and there are 5 components to it. This is different from control activities. This is components to COSO, so don't confuse the two. We have a control environment. This is tone at the top. It's setting the rules and policies. Then we have risk assessment. You have to have objectives. You have to figure out what your company is going to do. What do they want to accomplish? And then you have to look at it and you say, what are the risks that exist such that I will not meet those objectives? And then you have control activities. Control activities are the 5 things. Authorization, segregation of duties, etc. Now we have information and communication, because you need to be able to communicate your policies. You need to be able to figure out what needs to be done in terms of risk assessment and how to change those. And because it's a dynamic environment, you're going to reassess the risk. Reassess when you have new objectives. Reassess as your environment changes. And communicate the changes and share information. And in 5, which I just kind of alluded to, you need a monitoring process. Are your control activities actually sufficient to mitigate risk? So these are the 5 important components of the COSO framework. There's also a cube which is within that study unit, and I recommend you look at that and you understand it. The environment is also sometimes referred to, the important part of it is tone at the top. And that is a commitment to integrity and ethical values. This oversight is something that permeates throughout the organization. So it says the buck stops here. If I'm at this level, I'm responsible for these people under me, or these divisions, or these areas under me. And you think of a pyramid where you have individuals of we call them responsibility centers for the things that are underneath them. And it goes to the top, and the very top part of that is where you need to have tone at the top. The CEO, the CFO, the company has certain policies and procedures in place where they have the structure, they create the authority, and everyone has a responsibility for something. There's a commitment at the top of the company to ensure that the policies and procedures are in place and are being acted upon. So a part of this tone at the top directly relates to what we were talking about in COSO in general, and it has to do with having a framework and abiding by that framework and enforcing the accountability, the responsibility of individuals at lower levels. If you have something like this, you are going to see the CEO, the CFO, the board of directors is committed to establishing a very strong AIS system. You're going to see that they take internal controls, and having those control activities, having procedures in place, you're going to see that commitment. It's going to be a part of who the company is, and they take it very seriously. So there's enforcement, okay? There's enforcement. Risk assessment is when you have objectives, and then you go back and you try to figure out what might happen to this with the risk. You have to analyze the risk if the objectives weren't met or wouldn't be met, including fraud, if there's fraud that can possibly happen. And then you go through and you look at the changes that have happened in your business and the new risks that might be coming up. Maybe you have new objectives. So the new approach to risk is really came about after the financial crisis. We had COSO, which came about at an earlier point in time. But then when the financial crisis came about, there was a recognition we need to have an increased assessment of risk, and risk became more important in this internal control framework. We need to have the control activities in place so that our risks are mitigated. And we should have IT involved. And so in this class, at the end of the semester, we talk in great detail about IT. We're going to leave the Gleim book for a bit, but we're going to return back to the Gleim book at the end of the semester, and we're going to talk about IT. The CPA needs to know about IT. And when we have these control activities, and we are going to have detective, corrective, and preventive controls. So that model is going to come into the COSO, and that's how it does. Monitoring is a responsibility of management. It's ongoing. We're going to continuously evaluate it. And when we talk about monitoring, you know there's 303 and 404, and these are under Sarbanes-Oxley. And for the big filers, they actually have to test their internal controls to see if they are working. And they have to then go back and they need to communicate and they need to make the necessary changes so it works. Management, what should they do? Internal controls are costly for a firm to implement. Management must follow generally accepted guidelines consistent with what? And that would be looking at the costs and the benefits. What is not a component of the COSO framework? Yeah, that one's management directives. Management directives should be included and supportive of the control environment, but they are not considered of themselves a separate part of it. And you notice here we have not included things like monitoring and communications up here when we're talking about the framework. What's the emphasis after the financial crisis? Greater emphasis on risk assessment. All corporations are not equal. There's differences in them. This is all referred to as tone at the top. Management should be supportive of internal controls in place, or else the controls will be useless, because people do not like internal controls. They don't. I've mentioned that before. They're going to try to go around internal controls. They're going to try to go around those policies and procedures that make your AIS. They're going to try to do that. You have to have something that's going to enforce it. And your enforcement needs to come from the top. The top's commitment that you continue and you have an AIS that's based on policies and procedures in place. If your company changes, internal controls change. If you have a company that does everything face-to-face, now they're online. What are the new risks associated with having an online business? How do you control for those risks? What do you have in place that will help you address the threats to your business continuing to function in this online environment? Those are some questions you would answer. So it has to be dynamic and you have to see it that way. And 302 and 404, as I mentioned previously, 302 requires management to certify on a quarterly and annual basis. 404 requires management to assess internal control effectiveness. This assessment of internal control effectiveness is testing. We have certain objectives we want to meet. We have certain controls in place that should minimize the risk or should address the risk that our objectives are not being met. Do the controls work? Do they work? Let's test them. Let's see if they work. So the big companies, and I don't require you understand what size that is, the big corporations that are publicly traded have to follow 404. They have to actually test things. The smaller companies, they don't have to test, but management, CEO, CFO, has to certify or make a statement about internal controls, the effectiveness of internal controls. So 302, you make a statement. 404, you make a statement, but you're doing work. You're doing work. You're consciously addressing it. So you look at the investor's potential for loss. The thought is that the market share in their 404 companies is greater. Therefore, those companies should be doing more. 302, the market share is less, so they should be doing less. Now, the problem with that is when we talk about it and we talk about COSO, did you ever hear us say a big company should do that or a small company should do that? No. The COSO approach is that everyone should do it. This is the framework. This is the way any enterprise should do things. So COSO really doesn't make a distinction between size. It doesn't do anything like that. It says this is what you should have. You should be responsible for it. You should do things this way. You should have this in place. Again, the components, and then the control environment, and SAS is an auditing standard, and it says that the auditors, when they come in and do their work, they should have knowledge about internal controls. And at a minimum, the board of directors needs to adopt what SOX says, which is not a preventive control. Separation of responsibilities, recording, custodial, it should be, or custody, and authorization. That's an important thing to do, isn't it? And then background checks, we talked about that. Locking of automobiles, we talked about that. So all of those are preventive controls.